What if the bailout never ended? What if you're paying it every time you buy eggs, gas, or a streaming subscription? What if the rescue of the financial system is quietly embedded in everyday prices? They won't tell you this, because it doesn't look like a bailout. There's no late-night vote, no big check, no dramatic bank CEO on TV, just a slow bleed, a transfer, from you, at the checkout line, to the system that promised stability. To see it, we have to step back. Long before headlines screamed too big to fail, there was an older tool. Older than TARP, older than QE, a tool governments and central banks learned after big wars and big crises. When debts are too large and politics is too fragile, you don't default, you don't announce a bailout, you let prices rise faster than interest. You hold yields down, you call it stability. Economists call it financial repression. Everyone else experiences it as the cost of living. After World War II, the US was drowning in debt. Debt to GDP near 120%. Rates were capped. Inflation ran above those caps more often than not. Depositors earned less than prices rose, and debt melted in real terms without a public vote. It worked. The debt burden fell for a decade. And most people never connected their shrinking savings to the government's improving balance sheet. That lesson never died. In 1971, the last link to gold snapped. Prices swung wildly through the 1970s. Volcker later crushed inflation with painful rate hikes. But the memory remained. When the system strains, rising prices do quiet work. Fast forward, derivatives boomed, leverage crept in. 2008 hit like a freight train. We saw explicit bailouts, capital injections, emergency lending. The bill was obvious, and the public hated it. So, when the next shock arrived in 2020, the playbook shifted to something less visible. Fiscal fire hoses opened, central banks created trillions to buy bonds. Broad money exploded, supply chains snarled, and the official line was transitory. But here's the twist. Hidden in plain sight, inflation didn't just happen to us. It solved problems for the system. It shrank yesterday's debts. It boosted today's nominal revenues. It restored bank balance sheets by letting time and price do the heavy lifting. No one calls that a bailout, but the effect is the same. From 2020 to 2023, U.S. consumer prices jumped roughly 18% or more. Wages rose too, but lagged. Real rates went deeply negative. Savers with cash earned near zero. Purchasing power leaked away quietly. That leak is the fee you never saw. A $10,000 checking balance earned pennies while prices ran hot. In real terms, that's hundreds of dollars gone without a line item on any statement. Now follow the chain. Lockdown stimulus juice demand. Supply bottlenecks choke supply. Companies passed costs on and sometimes more. Profit margins, in many sectors, hit levels not seen since the 1950s. Was that greed? Markets doing what they do. The label matters less than the mechanism. When prices jump faster than costs for a while, nominal profits surge. Those profits repair balance sheets. And those balance sheets were carrying a lot of pre-pandemic debt issued at low rates. Inflation became an accountant's best friend. Then came the breaking point. By mid-2022, inflation peaked near 9% in the US. The squeeze was real. Rents erupted, groceries hurt. The Fed slammed the brakes with the fastest rate hikes in for decades. Great for the anti-inflation story. Terrible for banks stuffed with long-term bonds bought in the zero-rate era. When rates rise, long bonds fall. Hard, unrealized losses piled up in the hundreds of billions across the banking system. In 2023, Silicon Valley Bank tipped over. Panic flashed. Regulators guaranteed depositors over the usual caps to prevent contagion. And a new facility appeared. Let banks borrow against those underwater bonds at close to face value. No votes. No primetime speeches. But an effective bridge to safety. Who pays for the bridge? Directly, the system does via fees and assessments. Indirectly, you do. Banks pass costs by widening spreads, paying you less on deposits, and charging more on loans and fees. Deposit rates lag like molasses. Net interest income swells. That spread is a quiet recapitalization machine, and it runs on the difference between what you could make and what you're actually offered. At the same time, something else hides inside prices: the payments tax. Every time you tap or swipe, a slice goes to the network and the bank. U.S. retailers paid over $160 billion in card fees in a recent year. That cost gets baked into shelf prices. Even if you pay cash, you're subsidizing the system. Who benefits? Banks and the heaviest card users collecting rich rewards. Who funds it? Everyone who buys things. Another transfer embedded in everyday prices. You see it in other corners too. The FDIC raises special assessments after rescues. Banks don't absorb that out of charity. It flows into fees, spreads, and lower deposit rates. Healthcare systems get underpaid by public programs and shift costs to private premiums. Airline surcharges linger long after fuel spikes end. Again and again, when a sector needs a lifeline, the path of least resistance runs through prices. This isn't conspiracy. It's plumbing. It's how complex systems survive political limits. When voters won't accept explicit bailouts, the system uses implicit ones. When budgets can't bear higher taxes, inflation does the taxing. When a bank can't take losses today, time and spread do the repair, and you pay at the point of sale. What about the fallout? Trust takes the hit. People ask why their salary never seems to catch up. Why groceries cost more even when inflation is down? Because down means the rate of increase slowed. Not that prices return to 2019. New price levels become the floor. That's the trick. The bailout sticks. Smaller businesses get squeezed hardest. They don't borrow at the best rates. They don't earn on massive cash piles. They can't negotiate swipe fees like the giants. So they either raise prices more or close. Consolidation follows. Fewer competitors mean stickier prices. Another loop in the same pattern. And the fix is, we tried messaging. Transitory, we tried brute force. Rate hikes that risked a banking accident. We tried targeted relief, gas tax holidays, rebates, student loan pauses, price gouging laws. Each had side effects. Controls create shortages. Subsidies spur demand. Rate shock breaks something else. Meanwhile, the quiet fix keeps working. Let inflation run a bit above target for a while. Let nominal GDP grow. Let debts shrink relative to incomes and tax receipts. Let banks rebuild capital with fat spreads and time. It's not announced. It's not debated. It's just there, inside your cart. If this sounds familiar, it is. After World War II, inflation averaged higher than rates for years. Debt burdens plunged. Savers paid. In the 1980s, savings and loan losses were resolved, and the bill flowed through assessments and spreads. In 2008, the backlash to explicit rescues set the stage for more subtle ones later. And, 2020, the same old tools came out under new names. Look at the numbers around you now. Credit card APRs over 20% in many cases. Checking accounts often paying near zero, even as policy rates jumped. Big bank profits swelling on net interest spreads. Retail prices incorporating 2% to 3% swipe fees as standard. Rents and insurance premiums ratcheting up and staying there. These are not isolated facts, they're the ribs of a hidden transfer machine. So what do we do with this knowledge? First, stop waiting for a headline that says bailout. This one arrives through the scanner at checkout. Second, realize that price level is the story, not only the inflation rate. When the rate falls, the level remains. Third, see the pattern. When debt is high and politics is fragile, the system will choose the path of least resistance. Inflate it away, spread the cost. Keep the peace. 3 takeaways you can use. Inflation and negative real rates are stealth tax that bails out debtors, including governments, big borrowers, and banks. The financial system harvests spreads and fees embedded in everyday prices and payments. turning your purchases into quiet recapitalization. These mechanisms repeat after every crisis when explicit bailouts are politically toxic. So, expect them whenever debt piles up and stability is the priority. Here's the warning. Stealth can stabilize finances, but it corrodes trust. Too much hidden taxation through prices pushes people out of the formal system. Cash-only businesses grow. Shadow markets thrive. Politics polarizes. A system can survive broken balance sheets. It cannot survive broken legitimacy. So ask yourself, where do you see the hidden bailout in your life? Is it the swipe fee that the store won't discount for cash? The savings account that pays you crumbs while your bank posts record profits? The rent that reset higher and never went back? If this opened your eyes, don't keep it to yourself. Share this with someone who wonders why inflation is down but life is still expensive. Comment with the hidden bailouts you've spotted. Subscribe for the next deep dive, where we'll break down 7 practical ways to opt out of the quiet tax without checking out of modern life. Because they won't tell you this, but you deserve to see the bill.